Hi, I'm Jim Yant from Generations Wealth Advisors, the home of the Kairos Formula. It's Friday, April 24th, and this is our second quarter state of the market. We're trying to do a summary version here. If you want the more detailed one, please check our website. Well, we know what's dominating the headlines. It's the war. And so let's just summarize quickly. We've proved that the US military is the greatest in the world, but what's happened is there is really no way of winning this militarily. They don't have the resources, and we don't have the will or desire to either put boots on the ground or to destroy civilian infrastructure. So the peace talks is what's going on, but literally we have diametrically opposed views. They want to survive and continue the revolution in a future date, and we really kind of want the regime to go away, to have no nukes, no enrichments, no control of the straits. So some kind of diplomatic solution eventually has to happen. And as long as it's us versus Iran, it'll be hard to get there. If it's the globe uniting, and I know we've done some rough things with our allies, but if the globe can unite on freeing up the Strait of Hormuz, etc., we can probably get there. So it's the old Yogi Berra, it ain't over till it's over. Everyone likes us to be quick. This could easily be more than weeks, more than months. I'm just hoping we're not here come election time, but we can make a way through it. And why do we feel that way? Well, it's because in the past, wars are really any geopolitical event. We survive it. Markets survive it. As you look on any one of these attacks over various periods of time, if you go 1 year, 2 years down the pipe, markets lived through it and made it past it. So I know it's horrible that we're here, but if you have a long-term view, which is what we're trying to show here, green is an all equity, blue is an all bond, gray is a mix, a 60-40 mix. In the 1 year time frame, going back, over 75 years worth of data, on a 1 year time frame, the market could either be up 50 or down 37, and you see what it is for bonds in a mix. But if we move and say, let's have a longer perspective, a 5 year perspective, you'll see most of the negative returns and outcomes are kind of been diminished or very manageable if you think of it that way. And there's more upside than down. If you extend it even further, it keeps getting better and better. So that's the way we want you to think about this. And remember, from a Kairos formula perspective, we're going to deal with that intermediate period that we make sure your lifestyle, your income needs, your cash flow, we've already thought out a way on how we're going to weather the storm. At the beginning of the year, we always put one of these forwards. It's the Ned Davis cycle composite. It's a 1 year, 4 year presidential and 10-year view of the S&P 500 going back 96 years. And we say, this is history. It doesn't know anything about what's going on in current events, and past performance doesn't mean future performance. But if you were just to say, what's this year look like? This is what we put up there. And we always say, don't try to sell at the high and buy at the low. That's not the way we see it. We look at it and say, looks like it's an up year, but there's a lot of noise in the middle. We often like to then show you either midpoint or end of the year what it looks like. The vendor hasn't published one of those yet, so we just kind of put a little S&P year to date to kind of say, no, we didn't go up first like the chart did. In fact, because there is a real things happening rather than just history, a war broke out and we actually fell downward. It wasn't a full correction, only a 9% fall, but it was a negative outcome for a period of time. And once there was a hope of cease talks, you see that the market rallied very strongly. And, coincidentally, because, it's just history, they got up to about 4%. We're at about 4% on a year-to-date basis. So we expect chop, and who knows what's happening with the war. So we're going to weather through it. Why is the market and why are our investors having some kind of hope while we as just citizens are going, please make this end? Well, we always share our speedometers. This is from City National Rockdale. They have 20 different indicators on the market. It takes a preponderance of one color for you to really feel one way or the other. Remember, red is negative for the economy and the markets. Yellow is just neutral. I know people think of it as caution, but it's just neutral. And then green is a positive thing. You'll see at the moment, we really only have one negative thing. It is the actual priciness of the market, which, if anything, the last couple of months in the fear of the war, we had an 18% drop in the valuation level. The market only fell 9, but it became cheaper during that time period. Other things got worse: sentiment, fiscal policy, interest rates, of course, energy prices. But it's a healthy economy. It's still okay. That's the message we want you to get. So when we look forward, there's of the 30 plus research partners that we work with, we picked this one. It's Yardeni Research. They always do multiple scenarios, sometimes five, but we usually present three. A base case is what you see down the middle. And then to the left is one alternative. In this case, it's what if happens if there's a recession? Because when bear markets happen, 80% of the time a recession is either related or the cause. And then a right side scenario, which we were kind of more worried about just this time last year, that there was a melt up. There was like a tech bubble happening that would melt up and eventually burst and have a meltdown. Those are lesser odds than this middle case, which several folks are calling roar. The Yardenis called it the roaring 2020s. I'll show you in a minute how JP Morgan describes it. But what it basically says is we don't melt up and we don't have a recession, but we just keep having productivity gains that accelerate so that for the remainder of this decade, we can have growth. That's really what they're trying to tell you in this, right? Because everyone hears roaring 20s and they go, ooh, the last 1900s didn't go well. That's not what they're trying to say. Why is the consensus analyst estimates, was what you see on this page, so encouraging? Well, if you look at the second column down, that's the average over the last 30-ish years. And the top line, revenue about 4.5, 4.3, earnings high single digits. Scoot over one column, that's the consensus estimate of Wall Street analysts that says we're going to double the revenue this year, double likewise the earnings per share, and have a very strong double-digit profit margin. Scoot over one more column, they're saying, well, next year it might slow down, but those are still really strong numbers. So what that means is they're saying the economy, let's look at the chart on the right. You'll see the dashed line, everything to the left of it, that's history. So we see the economy slowing down, but just to the right of that first bar, that's the current year, 2026. And it's still above 2% is the consensus estimate, Fed Open Market Committee, Wall Street in general. And the belief is it might even get lower next year, but it still is a pretty strong, robust number, and they see a turn occurring at some point. On the right side, you'll see how they calculate that GDP. Most of it's consumption, at least in the United States, it's consumption, what we buy and take, but everything else is investment, either residential investment, business investment, inventories that it takes for us to buy the things, government spending and exports. If you add that all up, that's how you get GDP, the economy. Another way of thinking of it, it's what we call like the potential of any country. It's really two numbers. On the chart on the right, once again, the blue bars is how about the labor force? How many people are going to work, et cetera, et cetera. And what you see is over time, because the 2026 is right in the middle of that, the blues are shrinking. Why? Well, the boomers keep retiring, and we really aren't having as many natural-born citizens as we had in the past. And we've really kind of shut down, clamped down on immigration. I know there's been a lot of concern on immigration. Just put it in perspective, we got at a high at about a 1% immigration level, and our long-term run has been about 0.5. 0.5%. But right now it's like a negative. So you see the shrinking labor force. So you need productivity gains. You need a roar to happen. So this is why JP Morgan, this is one of their charts, said we need an AI lift to handle the economic drift. And when they call it roar, they think it's an acronym. R stands for reshoring, bringing back all of the important parts of our supply chains so we don't have to worry about pandemics or wars or getting in a fight with some other country over some issue. Reshore, bring them back on shore, optimize, the O, automate, the A, and finally robotics, the R, roar. So it's a combination of things, and lots of people see it as AI, but it's technology creating a boom because we have just less people. We need it. Now, AI, we're focusing just on pure AI rather than reshoring and some of the robotic stuff, really will come in waves. We've shared that in the past, and they're stacks. The first is what we'll call the tech stack. And this is what's been going on for the past couple of years. That started like a 22, 23. Namely, we need hardware, so it's semiconductors. We need, databases. We need large language models, and we need the hyperscalers. That's the first wave, and that continues to run. It hasn't run out of gas yet, but that's been really booming for several years. And the second column has been kicking in, particularly last year, which is, well, we need actual data centers built, and we need, more materials mined, etc. The third is, which is really the biggest and best wave whenever there's a technology revolution, we're really kind of in our infancy. It's when the technology gets used in every aspect of the business world as well as our personal world. And they just try to put a perspective on where we're at in that adoption. Look to the right side again. This comes from the end of March. The blue line says in each one of these industries, it's not the personal side, because you can tell me how much you're using AI in your personal life, but from the business world, in each sector of our economy, how much adoption has already happened. In some areas, it's quite significant. It's in the thirds, 30% range for personal, technology, information, education, finance, etc. But look at that bar in the middle, the box. It's saying, as a total country, really, we're in the high single digits. We're less than 20% of the way there. The gray is what we think in the next 6 months. So as this adoption continues, you're going to see more and more of that moving into the third column, which is where the real benefits are for our society. So to put some perspective on it, let's look at last and past technological revolutions. And so the PC is an easy one to look at. On every one of these revolutions, there's an initial euphoria when we first see it. And that's when you kind of get worried about the bubble because there's hopes that, it'll save humanity. And then as we really start to use it, we go, hey, there's some problems here. Like in the case of AI, there's these hallucinations and other things that, you got to fix these bugs. So we kind of sour on it. So the gray bars is that initial forecast, which we thought was optimistic when we did it. Well, when we start using it, we don't feel as good. But then once we fix the bugs, we actually underestimate it. That's the blue line. So just look at PCs. We underestimate it from a long haul perspective by 36%. The internet by 58%. Mobile cell phones by 36%. The cloud by 22%. And so we're in that stage right now with artificial intelligence. Initial euphoria, worried about a bubble. Oh my gosh, there's kinks to fix. But if we look back, I'll give you just one example. Did anyone think Amazon would be the largest retailer in the United States many moons ago, back in the tech boom? No, wasn't even in our consciousness. So that's where we're at. We, from a portfolio perspective, are happy where all our clients are positioned. We're going to keep our eye on the market. If you have any questions, please give us a call. Have a great day. Take care.